I'm going to attack the interest rate portion of this from a slightly different angle. So I want to go back to more fundamentals. So fundamentally, like why should stocks like interest rate cuts? I think this is a great segue into some investing 101, mainly some concepts that most investors I think are intuitively familiar with or they intuitively know, but they often forget. And so I think this is a good way to buzzword time level set. I hate that. I don't know why I use that. Anyway, there are two fundamental drivers when it comes to stock prices. And those two fundamental drivers are growth and inflation. And parenthetically, inflation is going to be tied to interest rates. And that's it. So we're going to focus on the interest rate part of this. So let's go take this very linearly. Stocks are valued on cash flows. I think most people will know that. I think they can grasp that concept. These cash flows happen in the present, of course, and they happen into the future, into the known future, and then into the vast unknown. And that's what's happening here. These future cash flows, though, have to be discounted back to the present. I think most people listening to this will have heard the phrase a discounted cash flow analysis. And basically, the idea here is that $1 million today is worth more than $1 million at some point in the future, meaning you've got to discount that future cash flow back to the present. Why do you do that? Because you can invest cash today. You can't invest cash today that you would get sometime in the future. So mechanically, cash flows have to be discounted back to the present. So when you do this, it really boils down to what I'd call elementary school fractions, your numerator, the top, and your denominator. So when you think about companies, when you think about stocks, the cash flows that companies generate are in that numerator. And your interest rates, what you're using to discount those cash flows, are in the denominator. So lower interest rates, all else equal. I think the term is ceteris paribus for those who've taken some economics classes. I may have butchered that Latin, but basically all else equal, if you have lower interest rates, that's going to make the discounted cash flow number go up because you're dividing by a smaller number. Again, it's fractions. Of course, there's a big caveat to this, and Dave, you know this as well as anyone. We rarely get the all else equal part. So I'm going to put out an extreme example, and we've seen this before, but I don't think we're going to see it anytime soon. I could be wrong, knock on wood, but here's an extreme example. Let's assume that interest rates go to zero tonight. They're currently 4 and change. They go to zero overnight. Would that make stocks go up? Well, based off of the situation I've just presented, you'd say, well, of course it'd make stocks go up. You're dividing your discounted cash flow analysis by a smaller number. But of course, in this scenario, the answer is likely no, like most definitely no, because what's happening in that scenario? What's happening to the numerator? What's happening to cash flows? What's happening to economic growth? In an environment where you're getting extreme rate cuts, that's implying that future economic growth is under attack. And of course, that's going to, again, cause that numerator to fall and likely faster than interest rates can help there in the denominator. So a caveat to this entire discussion, we said that stocks should like lower interest rates, all else equal. There's a caveat to this. Higher interest rates aren't necessarily a bad thing for stocks. And I think it surprised a lot of people. And they're not necessarily a bad thing for stocks so long as your numerator or economic growth and cash flows can outpace your rate increases. So we've seen, even with these higher interest rates post 2021, 2022, stocks have staged a pretty remarkable recovery. I mean, Dave, you mentioned we're back to all-time highs again. And I think the read here is that economic growth will improve cash flows more than inflation or higher interest rates is going to damage the discounted cash flow analysis that all these investors in the market are doing at all points in time. This is the game that investors and central banks are playing every single day. They're basically balancing the prospects of growth and inflation. Again, those are your two drivers for stock prices, growth and inflation. So this dynamic tension creates investor sentiment. And this is what causes us to come on the podcast in a good mood or a sour mood or talking about good news and bad news. But Dave, going back to your point on what the point of this podcast is and what we're trying to do for people, here's my takeaway of this and talking about investor sentiment, because we're being back to the all-time highs. When you start to see phrases in the news like, new paradigm, or other phrases like how far can stocks go, or God forbid someone comes out and says inflation has been slain or we're at the death of the business cycle. You talked about the possibility of a recession. Let's say the economic data picks up dramatically from here. If you start seeing, those types of phrases and language, and this is my favorite of all time. My cousin's a day trader. I mean, shut it down right there. That's when you should, remind yourself that nothing persists in perpetuity, that investor sentiment is probably swung one way or the other. And again, any sort of scenario that you can paint for why stocks should go up in perpetuity or why we should have a recession, what's going to cause stocks to go up or down. Again, all this comes back to those two main drivers of growth. And for our conversation here today, interest rates and inflation. So I think a secondary takeaway of that is do you have things in your portfolio that do well, not only when rates are down, but also when growth is down as well? And that speaks to bonds and other assets in your portfolio. So that's my read on this, a slightly different take on interest rates, but I think it's really good investing 101, reminding people that really there's two primary drivers for stocks and two primary risks. And those are growth. The opposite of that is recession, of course. And then you've got interest rates, either inflation or deflation. So that's my take on the whole interest rate topic.